Yamada, everyone. Thank you for joining our session. We're going to give it just a few minutes for everybody to join, and then we'll get started. Yamada, thank you for joining today's Retirement Savings webinar for Midwest United States, presented by the Aga Khan Economic Planning Board. My name is Azra Vandali, and I will be your moderator for this afternoon session. Before we get started, I'd like to go through a few housekeeping items. Please ensure that you are on mute. We do encourage you to submit questions in the chat function. We will have some time at the end of our sessions to go through a Q&A. The session will be about 60 minutes and a recording will be sent out to all participants after the webinar. We appreciate that you've joined us here today, and we hope that you learn more about how you can prepare yourself and your future through retirement savings. To kick things off, I'd like to introduce President of Midwest, Imran Datwani, to say a few words.
Thank you. Thank you. Can you hear me?
Yes, we can.
Yalimat, everyone. First of all, I want to thank our Economic Planning Board team, both the national team and the local team, and the Retirement Saving Plan Project team for making arrangements for this session. I know we have a large number of Jamaati members from Minneapolis joining, so thank you all for gathering in Jamaat Khana and joining for this session. And also thank you for those who are maybe joining individually from across Midwest for this session. And I hope that you enjoy and you learn from this session. And it's very nice to see that we have our Minneapolis Jamaat in such a large number coming together for this kind of event. You know, if you look at the end of terms normally, which means that when we have about 3 years and the last previous 2 terms have been 4 years, and at the end of that term, you send a report to Maulana Hazim Imam. Every country sends the report to Maulana Hazim Imam, and we share with Maulana Hazim Imam the economic condition of the Jamaat, the educational level of the Jamaat, the poverty levels in the Jamaat, and the health, and every single aspect of Jamaat's well-being is shared with Jamaat and with Hazim Imam. And in last term, we had, you know, at the end of the term, we have these roadmap that we come back with. And this is blessed by Maulana Hazim Imam. Hazim says, okay, I think, yes, based on the last 3 years or last 4 years, where the Jamaat is, what's going on in the world, Hazim Imam uses the word best practices. How do you take the best practices from around the world and use it in your daily lives? So based on that, Hazim Imam blesses the roadmap for the next 3 years, 4 years. And in this last term, which started in 2019, one of the goals was actually to talk about the wealth management, right? And very specifically, it was the multi-generational wealth management. But at the end of the day, it's all about how do you manage your wealth? How do you prepare yourself? And today, of course, this session is about retirement saving plan. But we have experts who are going to be talking about exactly how to plan for retirement. But I just wanted to take this moment and thank you for paying attention to this very important aspect of our lives, which is how do we make sure that not only us today are prepared, how do we prepare when we are in that retirement age, and how do we prepare that our Jamaat, our next generations also are prepared. So you know, these best practices, inshallah, if we focus on these areas, inshallah, we will be able to prepare ourselves. I hope this session, you enjoyed this session. I know we have had this session many times in the past in Midwest, and we always find Jamaati members coming back later and saying that, you know, it was very, very beneficial. So I hope that you have the same experience, and good luck with the session, and thank you for joining.
Thank you so much, President Imran. Let's go ahead and get started. I'd like to introduce our RSP presenter for today, Amin Mita. Amin is a business development specialist for Truist. He has his bachelor's and master's in science. He holds the designation of CHBEP and CPFA. He currently is serving as the National Project Manager for the Retirement Savings Program for Aga Khan Economic Planning Board. We are so honored to have Amin speak with us today. And with that, I'll hand it over to Amin to kick off our presentation.
Thank you so much, Azra. I am going to go ahead and share my slides, share my screen. Sorry, having a technical issue there. Can everybody see my slides?
I mean, we can see them, but we can also see the text around them.
Sure, I will. There we go. Everything okay, Azra?
We can't see your screen.
Oh, it sort of disappeared. I'm sorry about that.
That's okay.
Excuse me while I share this. Are we good?
Yep, we can see it.
Awesome. Thank you so much. Yarimat, everybody. Welcome to the AKB. My name is Amin Mita, and I'll be speaking to you about something that's dear to all of us, and that is retirement services. Today, if you think about it, there is 10,000 people who are retiring every single day. Let's take a moment and imagine what that is like in the numbers. And it is important that we consider what is going to be our quality of life. To tame retirement babat ma kya vichar keru che, and how does it affect your longevity and your future? Let me read the disclosure. This is an initiative by the Aga Khan Economic Planning Board to present educational information related to retirement. The information provided is not written or intended as a specific tax or legal advice. Individuals are encouraged to consult with their own tax and legal counsel. Today, you'll take away four things. One is the principles of retirement. What are the sources of income? What are the risks to consider? And how do you prepare for it? What are some best practices that are important? And so please take notes. You'll need lots of paper. And we're looking for questions afterwards of anything that you did not understand at the end of the session. So let's talk about the principles first of all. I think we can start about what is your financial well-being. You know, you go to the doctor, tame dar varse checkup karne jai che tamara health vaste. What about your financial checkup? Where are you? Do you have control over day-to-day, month-to-month finances? Do you have the capacity to absorb financial shock? Hamra baat thai che ke recession hase ke nahi hase, you know, where is it going to be? Are you prepared for if we do have a recession? Do you have an emergency fund to absorb that financial shock? Being on track to meet your financial goals, having the financial freedom to make choices that allow one to enjoy life. But how can you make financial choices unless you create those choices. What are the options that you've created in your financial goal to be able to decide, okay, this is what the economy is doing. Maybe this is my better option. So how does that all work? And that is something that is important to look at as you create your roadmap. And that roadmap is different for every single person and every single family. Okay. One of the important things is shukr alhamdulillah, we're living longer and longer. We have longevity. And so the average life expectancy for men is 76 and for women 81. So if you're going to be living longer, you'll be in retirement longer. And how is that going to affect you? What is that quality of life going to be? You know, with all the things that happen, what is it that you want to do and accomplish? And how do you want to live your retirement in your golden years? So the way to start from building your retirement strategy is there are 3 types of assets to have in a portfolio. First is growth. That's assets that you will continue to grow before you retire and after. So especially throughout retirement, it's important that it continues to grow. And then there's access. What is the access to your liquidity? Do you have an emergency fund? So if there was a shock in the economy, like we just went through COVID, how is that going to affect, and do you have access to that liquidity? I mean, who could have imagined that for 2 years we would be living at home and not be going out at all or doing anything? But here we are where the economy is recovering. We're all getting back to work and school and everything else and living life like we used to before COVID had happened. So having access to liquidity is really important. What is the predictable income? Income to cover necessary expenses, such as housing, mortgage, food. It is important to understand that kharcha che garna, everybody has that. Everybody's kavanu, gas, mortgage, bhareche. How is that predictable income changing, and how do you cover that? Right? One is to save regularly each year so that your nest egg grows. And the target is 15 times your income. So suppose that you are earning 100,000, then you should have $1.5 million when you retire, which is 15 times that. Tame hamra kamao cho, ne tamari salary 100,000 che ek saal ma, to tamar paase 1.5 million ho cho jai tame retirement ma hoye. And do you have that? How do you build that? You have to build it slowly so that egg is growing. And to replace 75%, the rule of thumb is that when you retire, you should be having 70% of that replacement income. So what does that mean? That means that if you're earning $4,000 today, for example, then during retirement, you need $3,000 monthly. Rule no tham ye che ke tame retire hamra kamao cho $4,000 mahine na. Have tame retirement ma jao cho to tamar paase 3,000 khapse mahine na. Dar mahine $3,000 khapse kharcha vaste, right? Because those costs are not going to be gone. So it's important to have, those are general rule of thumbs, and it's just a guidance. But what is your need? How is your financial future going to look? And what is the income that you need and the expenses? One of the key things is the value of compounding. So if you build $6,000 every year, then you can build that egg and nest egg 15 times by the time you retire. And the important thing is the earlier that you start, the better it is. So somebody who starts at the age of 20, and if they save 6,000 and they retire at age 70, they'll have almost $750,000. If it's somebody who's age 55, they have a shorter window to retirement. So that by the time they're 70, they'll have about $68,000. Now, one of the questions that comes up quite often, is it too late for me? It's never too late. Whatever you can save at whatever age will really come in and help that quality of life for you. So it's important to start as soon as possible. But if you haven't, you can start today. You can make changes to yourself that I'm going to start and open an account, and I'm going to save whatever I can for my retirement. The importance is, what's the difference between savings and investments? So savings are where you have money in your bank. The bank will cover $250,000 and it's guaranteed by FDIC for that amount. There's a minimum risk. It hardly earns any interest, but it is there, ready and accessible to cash. If you go to a bank or an ATM, you can draw that money out. There's also CDs, and those are locked sometimes, but you get a small amount of interest, which is now increasing as the prime rate has gone up. You have savings account of cash value life insurance. So these are all savings accounts. In contrast, you have investments. There's always a little bit more risk to those investment accounts. They also have a potential for profit, and it's harder to access the cash. And they can be stocks or bonds or mutual funds. So there is a difference in the amount of risk that you take and the amount of profit you get. And this depends on how you want to access it. What are the types of investments? So there are stocks, which are ownerships. And for example, Tesla. If you buy Tesla stock, or Amazon or Apple for that matter, those are stocks, and you can purchase them on the market, on the stock exchange. Those stocks go up and down, and they're sectors of maybe tech stocks or bank stocks or health stocks of many kinds. And then there are bonds. That's a debt instrument where the company like Apple has borrowed money to grow, and they give a lower interest rate and give a little bit, it's a little bit lower risk than a stock is. And then you have mutual funds, which are stocks and bonds and combinations. So this is another financial instrument. And then there are exchange traded funds. And these are on the stock exchange that you can purchase, and they have different amounts of risk and so forth. I think one of the important part is to understand the risk. What is your risk tolerance? If you have a certain amount of money and you're going to invest it, what is the risk that you're taking? And whether you invest it and have it in a savings account, or you have it in equities and bonds, or you have the cash equivalents. And it also depends on the age that you are. So if you're somebody who is in their 30s and you have a job, you have a long time or long window for retirement. And so you can afford to be aggressive. If the market goes up, it goes down, you still have time to recover. But if you're in your 50s, 60s, and you have 5 or 10 years, you are not wanting to take that additional risk, because when you retire, you need that money. So you may have a more conservative, and your portfolio will choose stocks and bonds that are a little bit more of a reduced risk, and you're able to go ahead and have that so that you know that it's going to be there, and so your risk is lower. So it's important to understand what you can afford in terms of risk and how much you're willing to. All right. It's important also to have expertise guidance. And I think this is where sometimes people don't go and get guidance from a professional that they need. And so it's important to get that knowledge base from attending sessions like this, as well as getting your professionals within your community that can allow you to give you that guidance. All right. This is a great slide. And the reason is because it shows you the 4-box strategy, which shows you in the first box, we have a predictable income, things like your Social Security, pensions, and annuity. And what are we going to use that for? We're going to use that for the necessary expenses, housing, food, healthcare. So if you know your monthly expenses and you have a predictable income source, then you know that, okay, this is what I need to cover. This is how short I'm going to be, or this is what I have over. And it's important to have that in retirement because your sources are going to be limited. And then income from assets. If you have investments such as stocks, bonds, and cash, and other things, those are for the discretionary expenses. Those are for the fun things like travel, hobbies, spending time with the grandchildren. Those are things that you'd like to do. And of course, you need income for that. So if your basic needs are taken care of on a monthly basis, then you can use the other income sources for the discretionary expenses, the things that you'd like to do. And now let's talk about the second part. Where is those sources of income coming from? And this is where it's important to create those options. And the earlier you start creating those options, the better off you have and the options that you have to move forward with it when you retire, right? So there are different areas of sources of income. There'll be IRAs, both traditional and Roth, and we'll discuss each one of these closely. There'll be 401ks. There's Social Security and annuities. And then there's other sources of income. So let's take each one and let's go a little bit more in depth and understand what they are. So IRAs are retirement plans that are individually owned. Unlike a 401k, you don't have to work for an employer. You can have and open your own account. The important thing is that you have income to show so that you are able to open that account. There are two types of accounts. One is traditional, one is Roth. Traditional is where you fund it with pre-tax dollars. That means that whatever amount you contribute, you haven't paid tax on it. So when you, in retirement, take that money out, you will have to pay tax on it at that time. In a Roth IRA, you're paying the taxes now. And so when you have that contribution, that money will grow tax-free. When you withdraw that money in retirement, you won't be taxed. And so it's important to understand the difference because there are slightly different rules that the IRS sets. I think the important thing to remember are two things. One is that you pay the government the taxes due only once. So if you decide to have a traditional IRA, that means you have to pay your taxes when you draw the money out. If you have paid your taxes already, then when you retire, you won't have to pay those taxes. And those are the basic rules for that. And what are the contribution limits? So in 2023, and these change every year, and the EPB updates them every year as well. So if you're under the age of 50, you can contribute 6,500. If you're over the age of 50, you can contribute 7,500. Okay. The IRAs, there are different rules in terms of both traditional and Roth. And what are the rules? Firstly, the tax benefits. You get a tax deduction when you contribute to your IRA. And so because you're not paying, you're deferring the taxes. So you will pay the taxes when you withdraw it. And when can you withdraw it? You can't withdraw this retirement account until 59 and a half. You can withdraw it, but you'll have to pay penalty of 10%, and you'll have to pay federal and state taxes. So that can be very costly if you do make the withdrawal. In a Roth IRA, you're penalty-free and tax-free after 5 years. You still can only draw after 59 and a half, but when you do draw, you won't have to pay taxes. Another thing is for the traditional IRA, there's a mandatory withdrawal. At the age of 73, this was this new Secure 2.0 rules that came in 2023 in January. The age got increased from 72 to 73. Let's take an example and go a little bit more in depth. So if you say you save $6,000 every year and you contribute that to an IRA account, in 40 years, you've contributed $240,000. And if that grows at an average of 7%, that means you have almost a little bit over $1.2 million in savings, right? Now, because it's a traditional, that means you haven't paid any taxes, it's deferred. So you will have to pay taxes when you withdraw. So once you withdraw, and suppose you withdraw at a 22% tax rate, it's lower than what you were when you were working, then you'd get a monthly income in your hand of $8,369 a month for 10 years. Let's compare that to a Roth IRA. If you have $6,000 and you save the same amount for 40 years every year, so you have $240,000, it grows 7%. And again, you have about a little bit over 1.2 million saved. And this, you have paid taxes already. So now it's grown tax-free. And when you withdraw it, there'll be no taxation for you. So when you withdraw it, you can take out $10,730 a month for 10 years. So depending on your income level, the IRS has rules depending on whether you're filing single, married, or jointly. There are rules in what you can contribute in terms of Roth IRA or traditional IRA, and it's important to know that. So you should speak to your tax consultant, your CPA, to make sure. There are other kinds of tax retirement accounts. For example, employers can have a simple IRA. They can contribute $15,500 for 2023 if they're under 50, and if they're over 50, they can contribute an additional $3,500. This is good for business owners with less than 100 employees. It's tax deferred. So in an IRA, you could only put a maximum of $6,500, but here in a simple, you can put in $15,500. That's also called a self-employment, a SEP IRA, which is also employer-based, and you can put in a maximum of $66,000 for 2023. And this is for any size business. It is also tax deferred. So both of these plans have different rules, and you should talk to a consultant, financial advisor to help you through that, and then also to your CPA if it makes sense for you, if you're a business owner, right? It's also important to have an account for the spouse. So the IRS allows a spousal IRA. So suppose a spouse, she could be working, or he could be working, or they could be at home and could be a homemaker. And so there's no income coming in. That's why it's called a spousal IRA. If you're married, you can open one and file a joint tax return. You can structure a spousal IRA as a traditional or a Roth as well. So you can contribute $6,000 for the husband and $6,000 for your spouse. And that allows you to double and also save for retirement account. And it's important that each of you have your own account and that you're saving as well, right? The IRS and the federal government provide a tax savers credit. And you get, if you're eligible, you're older than 18, you're not a full-time student, you're not a dependent on another person's return, you contribute to the traditional Roth IRA, 401k, 403b, or any of the other ones, you can get a credit of 50%, 20%, or 10% for your contribution of a retirement account, up to a maximum of $2,000 for a single or $4,000 for married. So let's take a deeper look into this. So if you're married and filing jointly, and your annual gross income is more than $43,500, you can get a 50% credit from the IRS for your contribution. If you have a gross income of $43,500 to $47,500, you get a tax credit for 20% for your contribution. And if it's 47% and 501 to 73,000, you get a 10% credit. If you're in more than 73,000, then you're not eligible for this credit. So this is 2023, and this changes every year, and it's published by the IRS. So let's go a little bit deeper in depth to understand how this works. If you're under 43,500 filing married and jointly, and you and your spouse each contribute $2,000, so that's a total of $4,000. You get a tax savers credit for $2,000, which is 50%. Now, your tax due was $2,500 before this credit, But now after the credit, you are going to be having to pay only $500. So that's a savings that you have, plus you've contributed to your IRA account. Are you eligible for this? If you are, you should talk to your CPA and your tax consultant and use this. Another area is if you're earning from $43,500 to $47,500 and you make the same amount contribution, $4,000. Now your tax savers credit is 20%, which is $800. So before you had to pay a tax bill of $2,500, and now you subtract that $800 and you're paying $1,700. So if you're eligible for these benefits, you should maximize and take those benefits and also contribute. Let's go to the next type of retirement. And this is more important in terms of a professional, but also for a business owner. A business can have a 401k, but mostly professionals who are working in a corporation are familiar with the 401k because it's company sponsored. Employers sponsor this retirement plan. It allows workers to invest in pre-tax dollars, and many employers match and contribute to the plan as well. So the contributions are taken out of your paycheck. Every year you decide how much you want to contribute on a monthly basis. So if you're paid twice in a month, then every paycheck, the company will withdraw automatically whatever you have selected. And then they will match that amount. And it's important that it's free money, and you should take full advantage of this because they're matching that for you and putting that into your retirement account. And what are the limits of a 401k? So if you're under 50, you can put in $22,500. And if you're over 50, you can put in an additional $7,500, which is a total of $30,000. This also changes every year like an IRA or the tax savers credit, and it's published by the IRS, and the AKEPB updates them every year. Let's talk about Social Security. This is a federal program. And as you come to retirement, you will be able to draw on that Social Security, provided you have contributed to it. So everybody who's working will contribute to it, and the corporation or the company you're working for also pays into that Social Security for you. If you want additional information, you can go to socialsecurity.gov and visit and get that information plus your statement on that. Okay. How does Social Security work? Well, the earliest you can retire is at age 62. This is when you're eligible with taking retirement benefits. The full retirement age, when you're able to get your full benefit amount, depends on your date of birth. So it's between age 66 and 67. And at the age of 70, there's no additional benefits if you delay. So let's take a look at it. If you have $1,000 that's due at full retirement age, and you decided to retire early, then you get 25% less. $750 would be your monthly benefit, and that's not going to change if you decide to opt for early retirement. If you take full benefit and full retirement age, then you will get the maximum, which is your $1,000. If you wait until the age of 70, you get an additional 8% for every year. So you get a 24% bump in the 3 years that you waited for, and now you're getting a monthly benefit of $1,320. So what is going to work for you? You need to look at that when you come close to retirement. You need to see the Social Security office and make sure that everything is okay and what your options are. Okay. And then there are other sources of income. So there's business ownership. So a lot of times, a lot of business owners say, I have real estate. And that's fine. You can have this as another additional source of retirement because it's diversification. The only thing is that when you want to pull the money out, you will have to pay taxes. You will have to, whether you can sell it, whether you got the price for it. So you have to be aware of that. Each has its own rules and how you're going to be able to draw that money back out. There's investment income, so what you've put in stocks and bonds and other financial instruments. Those also have rules. Again, you will have to pay taxes on them when you withdraw. So whether the market is up or down, that's going to depend on when you draw the money out and what makes sense. Income from part-time work or hobbies that you have. as I mentioned, real estate income or other types of income that you have. Life insurance, if it's a cash value life insurance, that's another source of income. And annuities. These are all sources of supplemental income separate from your retirement nest egg that you've built plus your Social Security. All right. Let's talk an important part, which is the risks to consider. There are certain risks in terms of the timing of when you are saving as well as when you're withdrawing that money. And it's important to consider that. We touched on longevity. So Shukr, like I said, we're all living longer, but the question is, we may live 30 or 40 years into retirement. What does that look like? How are we going to support that income? Where is that income going to come from? Did we save enough? The second risk is inflation. We really are feeling that now, and everybody can relate to that. So inflation was low before COVID, during COVID. Now the economy is picking up, and last year inflation was running at 8%. So we all go to the grocery store, we all fill gas. If you look at milk and eggs, the cost has gone up. If you go out to eat a restaurant, that cost has gone up. So now your dollar is not going as far as it used to. So it's important to consider that, okay, if I have my nest egg and I'm retired, how will inflation affect if I have to live on my retirement income? And how far will my dollar go? Will I run out of money? In both cases for longevity and inflation. Healthcare. The cost of healthcare is going up. That's another risk as well. So if I'm not taking care of my health, if I'm not going for my regular checkups, I'm not exercising my diet, there are certain risks as I age. Those risks I will continue to have. And what will be the cost of that? And how will I pay for that? Will Medicare or Social Security, do I have to get additional supplemental health care to make the payments? These are all things that are changing constantly, and that cost is also going up. Asset allocation. This is where your money is invested. So we know the market goes up and down. Am I diversified enough? If my portfolio goes, will I lose all that money? Or will I be able to buffer and wait for it to come back? And then withdraw. How fast am I taking that money? If I just take that money and rely on that bucket of my retirement account only, will it be enough, and how long will it last? So these are really important issues, and they affect everybody in a different way. And it's important to think about those risks and how to consider it. So let's take a little bit. Longevity risk is the possibility of outliving money. If you're 65 and you're living to 95 or 100, that's 30, 35 years in retirement. And it's very common now that people are living up to 100. So how will that affect you and the sources of income you have and what you've saved? Your buying power, we talked about that briefly. If you have inflation, where will your dollar go and how much will it purchase? In 1950s, a gallon of milk used to cost about 40 cents. Now it costs about $3.59. So that is the impact of inflation over time. What will the cost of milk be when you are in another 30 years or so when you're retired, right? Healthcare costs, as I said, they're going up. If you have acute health conditions and suddenly need medical attention, what's that cost going to be? And if it's a long-term, constant, chronic, one of the things that we do have that AKEPB does is long-term care. There's education on it. There's seminars on it. Reach out to your AKEPB, because the cost on a daily basis currently is $225 a day, or $6,844 a month on average. That's $82,000 a year. If you need constant care, then how is that going to look and who's going to pay for it? So it's important to have those things that will cover your risk and to give you a quality of life that you're going to be living. Medicare, the federal government provides insurance for program who's 65 and older. There are different types of plans. And again, what do you qualify for? And you can visit the www.medicare.gov website and understand how those impact you and whether you qualify or not. All right. Another area is assets of allocation. It's important to look at the assets and to see, are they diversified? Do I have my eggs in one basket? And you should take a look on a regular basis every year, and so that you don't have such a drop. If you invested all your money in Tesla stocks, well, that stock is down right now. But if you have it in many other kinds of stock, health, banking, and so forth, then if one sector is down, you will be buffered on the other side. So it's important to diversify and the type of sources of income. Right. As we discussed, the rate of withdrawal, how quickly you're drawing your money out. The normal rule is about 4% from your retirement, and that's reducing to 3% as a general rule as people are living longer. So it's important to turn that tap on, but to make sure that that tap is not so open that you use all that money up in one go. All right. I think the next stage and the last part is, how do you prepare for retirement? So here's some proven strategies. Get organized, get your affairs in order, make sure the bank information is correct, your beneficiaries, your investments are all okay, your retirement accounts, they're all properly, have the right names on them, the right beneficiaries, and so forth. Establish directives, make sure you have an up-to-date will. The AKEPB has a will session. If you don't have a will, reach out to them. I'm sure there'll be one in your region that you can take part in. It's important to have that, especially if you have small children. Make sure you have a health directive. Who's going to decide if you're sick? Who's going to make decisions for you regarding your health? And it's important to do that. As I mentioned, update your beneficiaries. And then also the important parts. Engage in activities such as exercise and hobbies. What do you like to do? Would you like to volunteer? Would you like to do part-time work? Do you want to travel or visit family? These are all parts of the retirement, and you should build on those to make sure that you have a great quality of life that's important to you, right? And it's important that you open your account if you don't have one for yourself or your spouse. We have the QR codes to reach out to Charles Schwab, our national partner. All you have to do is to take this QR code, make an appointment, and a financial advisor will schedule a time with you. You can ask them questions, and they can help you to open an account and get on your journey for retirement, right? And here's the feedback survey. We'd appreciate if you can join us and give us a feedback for that presentation. Thank you so much, and I will pass it back to Azra.
Thank you so much, Amin. That was a lot of really good information. I know I learned a lot, and definitely I'm going to make changes to my retirement strategy, so we appreciate it. Just as a reminder, we have sent the feedback link within the chat function of this webinar, and also the QR codes for the Charles Schwab locations. There are many Charles Schwab locations in the Midwest. You will receive an email following after this presentation that will have the link to the survey, the link to all of the Charles Schwab locations in the Midwest, and a link to the recording. So know that this information will be provided after our session today. With that, we'd love to start the Q&A portion of our session. So if anybody does have any questions, if you could please use the chat function or the Q&A function to submit your questions. We will have about 15 to 20 minutes to ask any questions that come through. We know that Amin had a lot to share, and we're very excited that this hopefully is a great way for you to learn what next steps that you may have. And if you have any further questions, this is our time to do it. So we'll give just a few minutes for those to submit a few questions in the chat function or in the Q&A function, and then we'll go ahead and get started with the Q&A portion of our session. All right, Amin, I have a couple questions for you to go ahead and start off. So the first question that we have here is, I get better returns from my business investments, which will be my retirement. Why should I save separately from retirement?
Sure, that's a great question. It's important, yes, the business is your retirement, you can invest in it. at the end of the day, you're growing your business and getting a great return. So we are in agreement there. There are 2 points to that. One is that when you withdraw that money, you're going to be taxed on it. And that tax could be a higher level than you need to be. And secondly, it's diversification. It's again putting your eggs in one basket. So nothing wrong with investing in your business. Take a small amount and also have a retirement account or other types of options so that if one sector like your business, for example, real estate, is down and you're not getting the return. So if you could not sell your business or you could not sell your property that you have and you're not getting the right amount, then you can afford to wait. But if you have all your eggs in one basket, you haven't created the options to make those decisions when you need to based on what's happening in the economy. And so you're forced to make the decision and then you have to sell it at a lower price and then you have to pay more taxes. And so then it's been a bad investment because your return is not really what it's been or what you thought it was going to be.
Okay. Well, that's very helpful. The next question that we have is, what is the income limit for contributions to Roth and traditional IRA?
The income limit for, we have an article, we'll pass it, I'm not sure offhand, but I think it's $138,000 married filed jointly. Don't quote me on it because I'm thinking on the top of my head, but there are limits to that. And we have the article on the Smiley USA AKEPB site, and we can share that article. And so that is what the limits are for traditional, and then there's Roth as well in that.
Correct. And I have put the link to the IRA contribution limits article in the chat as well.
Thank you, Azra. Awesome.
The next question that we have is, what strategies available for individuals exceeding the income limit for making contributions?
That's a great question. When you have a high earning amount, your gross income, then you're looking for some tax efficiency. And part of that is that there are different retirement accounts that you could be eligible for. And you really need a financial advisor who is versed in retirement and can give you that advice based on your situation. So like I mentioned, if there is simple, there is a SEP IRA, there's the 401k, there's profit sharing, there's cash balance plans. All of these have different rules. And it's important to speak to somebody who's knowledgeable, who can take that and understand your situation and what you're trying to accomplish so that you can make contributions. For example, in a cash balance plan, you could, if depending on your age, could contribute up to $300,000 in a retirement account. And you could get a tax efficiency on that as well. So that tax deduction would be much larger as well. So it depends what your situation is, what you're trying to accomplish. And really, I urge you to get somebody who is an expert in the area and can see your situation and is licensed and can give you, who's a fiduciary as well, which means that they're going to do what's in your best interest.
Great advice. Thank you. The next question that we have here is, for Roth IRAs, once it goes to your beneficiary, if you pass away, do the beneficiaries still get tax benefits when they don't have to pay tax? And do they withdraw when they reach 73 years old?
For the Roth, they will get the tax benefit because it's tax-free. The tax has been paid. So it just goes forward to the beneficiary. There is no RMDs on it, so there isn't, but the rules are changing. At some point, there may be some certain rules by the federal government that will say, okay, we are now going to start taxing, and it's going to maybe be grandfathered, and what that rule looks like and how Congress structures that. So it's important to be aware of what is going on, and especially to make sure how it's going to be taxed.
Question.
Or not taxed.
The next question we have here, what is Maulana Hazar Imam's guidance for saving for the next generation? Is it still 15 times the amount?
So Hazimam has not given any guidance in terms of the amount. What he has said is given guidance, and in the Hidayat and based on the last Hidayat, is that if you have wealth, transfer it. Make sure that it's available for the next generation, a little bit of it, that it is available for the next generation and to pass on. So the 15% is related to how much you should save for your retirement. It's a general rule and thumb. But the Imam has said that you should be able to, if you have the wealth, to pass whatever little bit that you can, in whatever capacity that you can, to pass it on to the next generation. And this is why EPB has created programs like multiple wealth generational planning. And these are sessions that EPB has been bringing along, including long-term care and will sessions. So all of this is based on Hazimam's Hidayat, including the retirement services.
The next question we have is, what is the role for Social Security payments to surviving spouses?
So that is going to be depending. There is payment in terms of a widow. So if you go to your socialsecurity.gov, you will have a statement that you can access. If you can take a look at that, that will give you what sort of, whether your contributions are correct, and you should check that on an annual basis. And then what you should be getting monthly if you're full retirement. And then if something happens to you, what your beneficiaries would be getting, including, say, your spouse, for example, if you have a disability. So all those things. Again, those rules can change based on the Congress. And so it's important that you go to the, once you've gone to the website and looked at the information, how does it affect you? What rules apply to you? And then go to the Social Security office and make sure that you're getting the right information correctly and you've verified that related to your situation, that this is what you would get.
Okay. That's great. The next question we have here is, if I am married, can I open a separate retirement savings account for my wife who is a homemaker?
Definitely. And it's important that you do that. So it's called a spousal IRA, and it can be a traditional or Roth. So it's important that you can contribute, and if you're filing married and jointly, you can open that account. And it's important to have one for both the husband and the wife so that you both are saving for your retirement.
Next question we have is, what is contingent beneficiary? Can we do it with all the service providers of retirement?
That is a great question. And I think people forget that you don't have to have one beneficiary. So for example, whether it's a bank account or it's a retirement account or anything else, you can put your spouse as your beneficiary, but then you can have a contingent like your children or somebody else. So a contingent is the secondary person. So in a life insurance, for example, you have the primary, and then you have the contingent, and you can have one or two or three or whatever. It allows you to have those contingent and what percentage should go to each one.
Great, thank you. The next question we have is, can I open an IRA account if I don't have legal status?
So if you have a no status, but if you have a TIN number, a tax ID number, then you may be able to open the account, provided that you have a business that you're working under. What I suggest is that you get tax counsel, because that's going to be part of it. And then you can use that to open a IRA account. So it's a little bit of a gray area depending on situations, because the rules are a little bit strict, and you want to make sure that you fulfill those rules and be able to open your account. But yes, it is possible to do that.
And what happens to the balance in a retirement account if there is no will or beneficiary?
Another great question. If you don't have a will or a beneficiary, it goes to the state. Let me repeat that. It goes to the state. So it is really critical and important that you have a will and that you have beneficiaries on your accounts, and you check them on a regular basis. It's important to have them because sometimes your situation changes. And you may want to change or add a beneficiary or remove a beneficiary. You should look at those on an annual basis and make sure that they're all up to date.
Great. Awesome. We're loving the questions, so please continue to submit them in the Q&A function. The next question that we have is, up to what age can I contribute to an IRA account?
You can contribute to an IRA account as long as you have income. So if you're 65 and you haven't taken retirement and you're working, then you can still contribute to that account, provided you have a W-2 coming in.
Great. If I have an IRA or 401k and I pass away suddenly, what happens to that money? I think you talked about this earlier, but.
Yes, it goes to the beneficiary. So it's important to have that beneficiary. If there's no beneficiary, it goes to the state.
Is it better to pay taxes later when you are in a lower tax bracket?
It is better, but it depends on your situation now. So suppose you're somebody who's in their 30s. Maybe they're in a tax bracket now where they're earning a certain amount of income. So let's take, for example, 100,000. And so it may be that they open a Roth account right now and pay the taxes now because they are. But say in the age of 40, they're earning maybe 250,000 or more. Then they are in a higher tax bracket, and they may want to then start contributing to a tax deferred account. So it really depends on age, and you should get financial guidance based on your situation of what is important based on your other financial situation in terms of your emergency fund and what you're trying to accomplish, whether you have a business on the side, you have passive income. All those things come into it, and what your tax consequence is. So it's important that you get advice from a financial accountant and then also a financial advisor who's going to help you to say, okay, I'm going to be in a higher tax bracket later on. And so I'm going to have Roth right now, but now when I retire, I'm going to be in a lower tax bracket. So let me go ahead and pay taxes now and defer it, and then take that money out where I'll pay the taxes. So that equation is going to be different for everybody, and they need to evaluate that and make a decision based on it.
And how often do these rules change?
Those rules change through the federal government and Congress. So you never know when it's going to be happening. So it doesn't happen every year, but they do change. So it's important to be aware of what's happening in the new laws that are enacted by Congress.
Mm-hmm. Next question we have is, can you convert your IRA or 401k to a self-directed IRA and then invest?
You are able to convert your IRA account. It's individual, so you can take that and make an investment. Depends on where you put it. So there are avenues. You need a financial advisor to help you, guide you through that, and to make sure that the tax consequences where it's transferred is going to be a tax efficiency way.
Great. And again, for those who have questions, we have about 5 more minutes left. If you can submit your questions into the Q&A feature in Zoom, that would be great, and we'll make sure we get them answered. The next question we have is, what is the difference between SEP and simple IRA?
A simple IRA is a retirement account like an IRA or a 401k, and it has certain rules. So with a simple IRA, you can put in $15,500 for 2023 if you're under the age of 50. And if you're over the age of 50, then you can put another $3,500. And it is also for business owners with 100 or less employees. A SEP IRA, you can go in and put in up to $66,000, and that allows it has different rules where you have to contribute 25% of your salary. That's the max that you can contribute to your retirement account.
Good to know. If the employer does not offer a 401k, what is best to do?
If an employer does not have a 401k, it's important to maybe open your own IRA account and to contribute to that. So you can have an individual retirement account and contribute to that and build your retirement.
Are you able to talk about trusts, or is that a totally different topic?
Trusts are an area where you have a lot of wealth and you want to move some of that through gifting. So I can talk overall a little bit. And right now, currently, when the Trump administration was there, they had increased the amount of what can be in the estate planning, and that's went from 5 million to 11 million. So right now, you can take and deploy up to 23 million for a married couple. So that's about 12.5 million for each that you can move into a trust and get the benefits of it. The Congress, that rule is going to sunset in December 31st, 2025. So if you have a lot of wealth, it's important to have an estate attorney, to have a good financial advisor and your accountant to see how you can use different avenues of gifting and other things to reduce your tax burden and take advantage. The estate attorneys are going to be very busy next year because I have a feeling that that rule will expire and Congress, basically the federal government needs the tax money. And so it's going to go back to the 7 million or so that it's going to sunset at. You never know. Congress could come back and say, we're going to let it stay there and remain there. But that's going to be another battle that Congress has to, and so we'll wait and see what happens.
Keep an eye out. This next question that we have, retirement in US versus Canada, what is better?
I don't know anything about Canada and retirement, so I can't even answer that and compare that. But where do you live? If you live in the US, it's important that you have your retirement here in the US. If you live in Canada, then it's important you have your retirement in Canada. Each country has its own rules. And so if you're living in both countries, then I would say you need a financial expert in both countries to help guide you and what the tax consequence is going to be.
Awesome. Next question that we have is, do you lose HSA contributions at the end of each calendar year?
The health savings account is a great vehicle to save and get a tax deduction. It's the only one which is a triple tax savings. That means that it's like a 401k. It comes out of your check automatically. It's saved. It grows tax-free. And when you withdraw it and use it for medical expenses, there's no taxes on it at all. So it's better than a Roth account, actually. There's limits. So right now, if you're under 50, you can, I think, put in $8,000 a year, and you can use it only to pay for your medical expenses, your eye expenses, and your hearing or dental. But you have to qualify it by having a high deductible medical account. And so you don't lose it. Unlike a flexible spending account where you lose it after a year, now you can roll it over, and it's a good way to save for medical expenses for your retirement if you save every year that amount and don't use that.
Great. Another question that we have for following up with the trust that we were just talking about, will existing trusts be grandfathered?
They will be, but what I would highly recommend is that you get it reviewed by your tax attorney and financial guidance advisor to make sure that it is in line. There may be certain rules in your trust that we don't know that may complicate things. So it's always good to get experts to review that individually to make sure that you fulfill all the requirements of what the impact of that sunset's going to be.
Sounds good. Again, just as a reminder to please submit your final few questions. We will wrap up in the next few minutes, but we still have a couple more to go through. Amin, could you go through what does it mean when a company says not insured by FDIC for a brokerage account?
Sure. So the government, the federal government has the banking system, and they guarantee 250,000 federally insured corporation account. So that allows you to have guarantee if you have a single account in the bank. And we know that we've had some bank closures recently, Sunny Valley Bank, and then Republic got sold. And those accounts were fully guaranteed more than the 250,000 by the government. So, but brokerage accounts are not guaranteed. So if you have your money in retirement accounts and stocks and bonds and other things, they do not guarantee that if a company closes or a brokerage company closes, that your account will be guaranteed in any way for it. So that's the difference.
Question that we have to follow up on that, 250K FDIC insurance is per account per bank, or how does that work?
Yeah, it's per account per bank. And if you have multiple accounts, then each one up to the maximum of 250. So if a bank goes into bankruptcy and then if it's more than 250,000 in that account, normally in the past couple of this year, 2 banks were affected by it and they were covered. The government, President Biden and the Biden administration guaranteed that through the banking system, right? It could happen that they were not guaranteed and they won't. So anything that the government is able to do, they will guarantee that up to the 250,000. Anything over that, it's not guaranteed. So each account is guaranteed up to that amount. And it's important to know that. But I think we have a great, strong banking system now. We've had a lot of rules that were put in place after the 2008 financial crisis. And so those are helping to have support and guarantee people's deposits.
Follow up to that, in that case, is it good not to keep more than the limit?
That's a question that is going to be dependent on you and what your situation is. You can have several accounts, each with 250,000, and you can put it into other areas of guarantees. So it's important that you look at that and you say, okay, where are the guarantees that I can get? And you should be consulting your financial advisor and the banking system to see what are the other options available to you.
Next question that we have is, I am new to retirement savings and I'm trying to find a financial institution that fits for me. Where should I start?
So you've started right here. We are national partners with Charles Schwab. You can go ahead and the QR codes that will be sent out, you can go ahead and look at which is the closest office to your Charles Schwab. And once you put your phone number and email, they will reach out to you and schedule a time. They will give you a consultation and help you to open that account. And so it's as easy as that.
Awesome. All right, we'll give it just a few more minutes for any last minute questions to come through. Can we have another session on trusts, or is there somewhere I can go to learn more about trusts?
You can definitely, we'll make the request to EPB to have, maybe they have something in the works for trusts, but you can also educate yourself based on a lot of the banks have trust availability and they have resources. So you can look at that. A lot of brokerage firms and financial advisors also have access to trusts. And so you can also have a look at that and access that as well.
Great. What is SIPC?
SIPC is where it's especially insurance and brokerage. That's where it is being covered. And that's the guarantee that they give. They don't give dollar amounts, but they do give certain guarantees for certain accounts.
For the partnership with Charles Schwab, are they negotiated fees?
There are no negotiated fees depending on the type of account. So when you meet with your Charles Schwab financial advisor, you can ask them about the fees because those are currently always changing. It depends on the type of account you want and the service you want. So if you're putting in a larger amount, they may charge you a certain amount of fee, but they're chosen specifically because their fees are a lot lower. We also have an article where we audit other platforms, and you can look at those and see which one fits you, because their services are different and they have different things that they're offering. So the best thing is to make an informed decision, and the EPB has an audit on all the financial platforms, and you can take a look at those.
Awesome. Is the limit of SIPC protected 500K?
It is, I don't remember offhand how much it is, but it is covered for the brokerage, and it is for that brokerage firm, not necessarily the client, as we say. So make sure you ask that question to see exactly which brokerage is covered, but that is also covered by the SEC and given that.
How does commission impact the retirement fund?
Commission depends on when you have a platform. So all the platforms have mutual funds. They all have standard fees. They're low, whether it's Vanguard, Fidelity, or Capital. All these platforms using multitude of mutual funds where the money is being contributed towards and growing. And they all have certain costs to it. So to operate a fund, those costs are distributed around, and you have those costs. So make sure you look at those. And then whatever commissions to the financial advisors, those are also. So when you have a financial advisor, being security licensed, they are supposed to let you know in advance what those fees are, and you should ask them those questions, and they will explain to you based on your situation what those fees are going to be and how it impacts you.
Okay. Our last three questions that we have here. What if the performance of a fund manager is not up to mark?
Then you have the ability to move those funds to another fund manager and other funds. So there are so many funds and so many fund managers. If it's not working for you and you're keeping an eye on it, what are the better options? Get your guidance, do some education, do some information in terms of yourself, and then make an informed decision that works for your situation.
What is the difference between self-managed and a managed fund?
A managed fund is where you're paying commissions to a advisor to manage that fund. Self-managed is where you're managing those funds. But both of them have fees in addition for those funds themselves. They don't go to the advisor. Those are funds, those are expenses and costs related to the fund itself. So even if it's self-managed, you will be paying those charges on the fund that you choose.
What is rollover of retirement fund?
Rollover is when you have you're working for a company and you change companies and you want to move your 401k to that other company or somewhere else. You're rolling that over. And you can leave it there. So the options are you can leave it with your old company and start a new company and new 401k. The second option is that you can roll it over to the new company, and that's just a transfer. You just have to let the old company know and fill the paperwork out, and it's gone. Or you can roll it to another platform, and you can choose which platform. So all this is done where appropriate documentation is done. It's done safely, and you just need to make sure that you're having it moved. If you receive that money as a check, then you have 60 days to put that money back into a retirement account. Otherwise, you'll be taxed on it and pay a penalty on it. So it's important that you just do it from institution to institution and have it roll over.
Awesome. Well, the last question that I have for you today, is what is the one piece of advice that you'd give to everyone joining us today for our retirement webinar?
I would say retirement is really important. You should open an account for yourself and for your spouse if she doesn't have one. Start small, start somewhere, and make it a habit to open that retirement account and check on it regularly. Attend sessions like these or anywhere outside. Also get guidance. get a financial advisor who you trust, who refers to you, who's licensed in your state, and who knows about retirement and who can help you, guide you, and help you make informed decisions. And talk to your CPA and ask those questions as to how you can do that, because this information is changing. AKEPB is updating that, and we have sessions through the EPB, whether they're will sessions or their retirement services or long-term care or multiple wealth generation. Attend those sessions. We spend a lot of time, volunteer time, to prepare for these and to bring this information as quickly as possible and updated to the Jamaat. And so the information is available. I would say take that time and get onto the road for retirement and for your family, as well as the quality of life.
Well, thank you so much, Amin. Thank you again for President Imran, who joined us earlier, and for Amin for spending their time and honestly sharing so much knowledge about retirement savings. We hope that everyone who's joined us today feels more prepared, has time to make a plan, and really start saving for your future. In the chat, I have added a few links. So we have our the.ismaili USA Retirement Savings webpage. There are tons of articles that the AKEPB team has written on different topics such as Social Security, IRA contributions. So we really do advise everyone to take a look at that webpage. There also are recordings of previous sessions that our team has done, as well as the email address to reach out if you have any questions. So if you do have further questions, please email our team at rsp.epb.usa@gmail.com. And there is also a link to the feedback survey. We appreciate your honest feedback. We do these sessions quite frequently, and we want to make sure that you get the most out of the session. So again, we would love your feedback. You will be receiving a follow-up email in the next few days with a recording of this session, the links to the retirement savings program, the .ismaili webpage, and the email address that you can ask any questions to. But again, we really appreciate that everyone has joined us today for this program, and we hope that you have a good day. Thank you, and Yali Madat.
Thank you, Yali Madat.